Okay, welcome to the March 14th edition of the Fats, Fuels, and Oils webinar. This week, we're going to cover the last week's WASDE report, the MPOB report, and take a look at our expectations for the EMTS data that is going to come out on Thursday. And then the last thing I'll say is just a little housekeeping. This week, I am going to write a report before the end of the day today. I will write reports and get everything updated. And I finally finished my long-term outlook report, so should be back on schedule. And we're in the process of hiring a junior analyst. So this last month should never happen again. All right, with that, let's get going. All right. So the first thing I want to talk about is what's gone on in Argentina and USDA's, the changes that USDA made to their production forecast and expectations for the Argentine crop. As you can see, USDA cut their forecast to 33 million tons. That's still 4 million tons above where the Buenos Aires grain exchange is. We are a little bit higher. I haven't really gone in and adjusted my forecast yet. I've been at 39 million tons, and when I make the adjustment, I'm not 100% sure that I'm going to come all the way down to where USDA is, and probably for sure not going to come down to where the Buenos Aires grain exchange is. If we look at the rainfall in Argentina this year, you can see that we've had some good rains recently, and it looks like finally the long anticipated change in the weather pattern is here, so that they're going to get more frequent rainfall. But from January to March, essentially, there wasn't really enough rain. And just in case you're not great at conversions from millimeters to inches, it's about 25 millimeters per inch of rain. So they had about an inch of rain in sort of mid to late January, followed up by another 3/4 of an inch-ish. And then really not much between then and when it started raining again here recently over the past week or so. In addition to it being relatively dry, it's also been really hot. And all of that would suggest that that USDA and the Buenos Aires grain exchange are certainly closer to what the final number is going to be than my 39 million. However, if you look at crop progress, there is still a substantial portion of the soybean crop that is in the pod filling stage. Now, I've said on this call a lot of times that a really good way to get big yields is to stress soybean crops early and then pour a bunch of rain on them while they're filling pods, because essentially what happens is that tells the plant, hey, don't focus your energy on building a nice big canopy and big tall, shoulder high plants that just look beautiful, but focus all of your energy on passing on your genetic material, which is in the seeds in the pods. However, given the heat and the extreme period of just literally no rain, there does come a point where a soybean crop just can't recover. And before the crop sets or before the crop fills pods, obviously it has to set pods. And so what happens is if a crop sets pods and then it continues to be hot and dry, it will start to abort those pods. And there comes a point where you're never going to get back to trendline yield. And then it's just a question of how much do you take off of trendline yield. The other thing that I think probably is going to reduce production is there will be more abandonment this year than in the average year. So some fields are just going to look so poor that they're probably, to the extent that they have crops on them, they will probably be chopped and turned into feed. And so my suspicion is that even though I think yields are probably improving from where they were at the beginning of the month, I don't know that we're going to get all the way back to trend line, certainly even 39 million tons, which is already 11 million tons below where expectations started for the year. My guess is I probably will be at maybe 35. I really have to kind of take a deeper look at this and see. And maybe next week I'll come back and tell you, yeah, I'm at 30. But I don't. It doesn't feel that quite that way to me. Now, all of that said, if you look at last week's weekly crop condition report from the BCBA, the Buenos Aires Grain Exchange, 71% of the crop was rated poor or very poor, and 75% of the growing area had very short soil moisture levels. So conditions certainly aren't great for building on yields. However, if you wanted to recover from a period of really hot and dry weather, what you wouldn't want to do is then get 5 inches of rain all at once, because it would tend to, the first, I don't know, 5 inches might not be a great example, 2 inches of rain all at once, because the first 1.5 inches is just probably going to run off the soil because it's hard, and run into the gullies at the edge of the field, or run into just not be available for the plant to use. And if you look at the forecast, while we don't have, tons and tons of rain, we are greater than normal, I would say. I think if you look at the slope of the line of the predicted cumulative rainfall relative to the average slope, it's about the same. So I think you could say that going forward, they're going to get about average rainfall, and it's going to come in smaller amounts that over time will start to recharge the soil moisture. That doesn't mean that 3 weeks from now we're going to come back and look at this and soil moisture levels are going to be 25% poor or short or very short. But it is sort of a good way to come out of a period of hot and dry weather. As I've said before, while Argentine farmers hold stocks against economic uncertainty, and in those stocks, excuse me, will help offset some of the crop losses, and the Argentine government has a real incentive to encourage farmers to sell those stocks to crushers, we're at a point where further reductions in my production forecast are going to result in decreases in my expectations for Argentine crush. Right now, if you look at the year-over-year change in my Argentine crush forecast, it's not that much. In USDA, even though they made a significant reduction in their production forecast, only cut crush by, I think, 500,000 tons, if memory serves. But even if it wasn't that exact number, it was not a huge number relative to the size of the decrease in production, in their production forecast. And that could be important because it may mean that, well, it certainly will mean that Argentine soybean oil export probably will not be as high as they would be, obviously, if crush were higher. The question then becomes, how much does Brazil step in to fill that gap that's left by Argentina? And again, given the fact that the Brazilian crop, although USDA didn't change their forecast for Brazilian production, they left it at 153 million tons, is big enough that that's still a record crop. So it's big enough for Brazilian crushers to potentially increase crush and fill in that gap, or at least some of that gap. It may also be the case that that it will increase U.S. soybean oil exports out of the Gulf. Now, I don't mean that I'm going to go from 500 million pounds to a billion even, but I may go from 500 million to 600 million or something like that. And given the sort of expectations for tightening U.S. soybean oil stocks, every 100 million pounds of supply counts. And so we'll have to see whether U.S. exports actually ultimately benefit from the reduction in Argentine production. But it is something that is at least a possibility now that we are taking the Argentine crop down below a level where crush is essentially unaffected by the decline in production. All right, so the changes that USDA made to their 2023 new crop soybean oil forecast, basically they cut exports down to 500 million pounds, which really kind of surprised me. I mean, like I said a couple of weeks ago, or maybe last week, even though my forecast was at 500 million, if you looked at some of the numbers that I used to track soybean oil exports based on the weekly export sales data, those kind of suggested that maybe it should have been closer to 700 million. So I was a little surprised that USDA came all the way down to 500 million, but that is sort of the pace of exports that we have. They also decreased production a little bit on a slight decrease in their crush forecast. And then they increased their domestic non-biofuel usage. And I think that was a function of if you looked at the implied non-biofuel use for December based on NOPA data, before we got the EIA data, it implied that total was going to be below 1 billion pounds. And by the time we got USDA's estimate of production and stocks, that rose back up to 1 billion. And then by the time we got the EIA feedstock data, it rose a little bit more. And so if you look at non-bio use in the first quarter, while it started really, really strong and has kind of tailed off with each successive month, it hasn't been as weak as that early NOPA data implied. And so I don't really disagree, even though I'm way my forecast is really, really far apart from where USDA is. I don't necessarily disagree with that move, and certainly understand the reasoning behind it. And if I thought that as I change my forecast for biofuel feedstock demand, any reduction in that number is going to go straight into non-biofuel use, because I think that non-biofuel will certainly end somewhere above my 13 billion pound prediction. I kind of have to use that number right now just because that helps me keep ending stocks at a number that seem reasonable. And there is a good chance, and we'll get into this a little bit later, there's a good chance that feedstock demand will be below my expectations. The only other thing that I would point out about this, beyond the 2-cent cut that they made in their forecast for cash prices, which again don't necessarily disagree with in the short term. In the longer term, I still think prices in the second half of the year are going to rally. But the only other thing that I would point out is if you look at the trade balance for the US for 22-23 at this point, we have imported 7.8 million pounds of we have imported 7.8 million more pounds of soybean oil than we've exported. That number is literally meaningless in the overall scope of things. 7.8 million pounds is nothing. But the US traditionally obviously has been a significant exporter of soybean oil. And so to be a net importer through the first 4 months of the marketing year through January is a significant change in the fundamental structure of the soybean oil market. And I doubt that ultimately, based on my forecast, ultimately we export a little bit more than we import. But it is interesting to think that we have sort of finally realized this situation where that I think most analysts have been expecting for the last couple of years, where exports have fallen enough that that we actually are a net importer of soybean oil. Now, I also don't think that this is the beginning of a period where we become huge net importers of soybean oil because of the tariffs that are on US soybean oil imports. But if anything were to change with those tariffs, then I think that outlook would be dramatically different. And I think that that the US would probably import significantly more soybean oil than we would export. For canola supply and demand, USDA didn't make any changes to their forecast in the March report. At the end of this month, we'll get the oil crops yearbook and the associated data set. That is the one spot where you can get a canola oil of a full canola complex balance sheet that isn't in metric tons, so you don't have to do the conversion from metric tons to pounds, and you get actual real numbers. And so I think that the changes that they made in the February report were really in preparation for publishing that report. And so based on that, not necessarily surprising that they didn't make any they didn't make any changes in their forecast in the March report. And this is the time of the year too for canola where domestic demand obviously can change throughout the year, but it's kind of a downtime. It's just kind of the low time in terms of changes in canola oil fundamentals, and so it's probably relatively easy to kind of stick with the numbers that they had. The one thing that I would note so far is that if you look at the year-over-year increase in domestic use, that is up in January anyway. That was up 57% above where it was last year. I meant to grab the cumulative number, but it's a safe bet that the cumulative number probably isn't 57%, but is probably a significant increase. And while a portion of that increase has come from stronger biofuel use, especially in December, a lot of it has come from non-biofuel use. And this kind of supports the idea that as feedstock demand rises and biofuel producers use more soybean oil, that canola oil demand is also going to rise because there's going to be substitution of canola oil for soybean oil in the food industry. And so this is something that I expect will continue. Again, I'm not quite as optimistic about non-biofuel use as USDA is right now. That said, it looks like canola oil cash prices remain really competitive with soybean oil prices. And so this is a trend that, again, I think probably only accelerates as we go through the year, assuming that the idea that we start to use more and more, we produce more biofuels and use more biofuel feedstocks as we go through the year, and that the increase in canola oil feedstock demand is not that substantial. So we don't go from, it was 170 million pounds in December, and that was up from kind of 130 or 140 before that. We don't go from 170 to 350 million pounds a month or 400 million pounds a month, something like that. I don't think that's going to happen. I think that that we probably are going to stay around that 170, maybe a little bit higher, maybe 200, 225 million pounds a month going forward. But we'll see how it goes over the next couple of months. As I've said before, there were reasons that the canola oil use for feedstock is going to be a little bit stronger, I think, at the beginning of the year than probably the long-term use, because canola oil has been really competitive with soybean oil. Two, the approval of the RIN pathway for renewable diesel producers bought canola oil in anticipation of that. We'll see whether those purchases were opportunistic or whether that's actually how much canola oil is going to be used, because some of them weren't in places that you would typically expect canola oil to be really competitive. So whether those continue or not is going to be one of the questions that will get answered as we get more data from the EIA in the coming months. I tend to think that if canola oil stays competitive, obviously, then usage probably will be a little bit higher. But if that happens, then I think canola oil starts to move back. The price of canola oil starts to move back towards the long-term average spread between, or the long-term premium over soybean oil. I don't know that it will go all the way back to the long term because of the fact that we had a pretty good crop last year, and because the most of the demand pull is going to be on soybean oil. But again, we'll see, and if this non-biofuel, if the growth in non-biofuel continues at the pace that we saw in January, then ultimately I'm going to need to raise my non-biofuel forecast, and then two, probably will need to raise my import forecast as well. We talked about that last week, and whether that actually is something that will make sense given the level of Canadian exports. It looks like Canada has enough to do that. But the question will be whether Canada exports more seed or continues crushing at the pace that they have been crushing, which is pretty close to the record pace that we saw a couple of years ago. For Canada, USDA also did not make any changes to their forecast, and our main difference here is again on exports and on domestic usage. We, in the long-term report, we built out our Canadian biofuel sector, Canadian biofuel model, I guess. So we have our projected demand for Canadian feedstocks. and that turns out to be 276,000 tons in 22-23, and then that starts to grow in the coming years as the Canadian CFR starts to really kick in September. It's already in place, but as I understand the program, the credit portion of the program, the credit and deficit portion of the program doesn't start until September. And so then I think you probably will get greater usage after that. Now, that said, recently there was one of the companies that had planned to build a biofuel facility in Canada announced that they were backing away from that project, primarily because the IRA didn't support, or if you import the biofuel, you don't get the IRA credit, where now you get the blender's tax credit, and that obviously has a substantial impact on economics. And so the capacity that Canada needs is probably more in line with domestic biofuel demand than it is sort of domestic biofuel demand and how much can we ship to the California market. So while that number is relatively small right now, I do expect it to grow in the coming years, but I don't expect it to be, I don't expect it to have the same impact on the Canadian market that we've seen in the US market. The totals just don't get that large for canola oil, which will be the main feedstock used in biofuel production in Canada, obviously, I guess. The Malaysian Palm Oil Board, or the Malaysian USDA's Malaysian forecasts, they made some changes. They increased their production forecast and offset that with an increase in their exports. Again, no real disagreement with the changes that they made. The one area that I think that we don't agree on, and it's a little bit because the data kind of has been really volatile over the last several months, and that is imports. So after the most recent Malaysian Palm Oil Board report, I cut my import forecast again because this past month imports were back down to sort of 40 or 50,000 tons. Next month they probably will be back up to 100,000, and then I'll have to change my my forecast again. The one thing that I would say about my Malaysian balance sheets is that based on the pace of production and exports right now, I'm having a hard time sort of getting rid of all of the supply. Not that there's a ton of supply, but just based on those assumptions and then my assumption for ending stocks, domestic demand, non-biofuel domestic demand grows 16% year over year. That leaves it at the upper end of the, or not 16% year over year, sorry, 16% versus the 5-year average, more than 16% year over year. The forecast that I have now leaves my prediction at the upper end of that 5-year range. It's around 850,000 tons for non-biofuel usage. I don't have a ton of confidence in that number, and I think that it probably will come down, but I don't really want to take my ending stocks number up more than I have. And this week I took it up 200,000 tons to 2.3 million, which is in line basically with where USDA is and above kind of that bullish bearish line. However, if you look at what the Malaysian Palm Oil Board said for production in February, it was down almost 10% from January. Now, February is a shorter month, so there's going to be some reduction, and it came in a little below market expectations. This, sorry, I'm looking at this chart. Typically, what I did, I didn't predict all of these numbers exactly where Malaysian palm oil board data came out, pretty obviously. What happens is generally I take a picture of this before I fill in the data from the Malaysian palm oil board in my actual balance sheet. And because I was rushing this morning, I kind of forgot about that and ended up taking the picture afterwards. And I have the original around here someplace. That doesn't really matter. Anyway, production came in a little bit below market expectations. And there is this worry that production will slow more than expected, or I guess since we're at the bottom of the season, of the typical seasonal drawdown, will grow slower than expected over the balance of the marketing year, especially if prices kind of fall below the 400,000 or the 4,000 ringgit level. And again, given expectations for a carryout of 2.3 million tons, that would suggest that prices probably could. However, I think that with the shortage, with the shortage coming out of Argentina and the lack of exports out of the U.S. Gulf, we've seen the spread between palm oil and soybean oil narrow pretty dramatically. Now, it still is way above where it has been historically, but it's well down from the highs that we saw around 30 cents. And it could be that that prices and production remain supported by demand that would have gone to Argentine soybean oil or US soybean oil, especially in developing countries. They will switch back to palm oil. Not that they probably switched given the 30-cent premium for soybean oil, but there is a chance that even though the ending stocks expectations are rising and above that 2 million ton level, that the world situation will help support soybean or palm oil prices. And that's especially true if soybean oil starts to rally again. Again, not that if soybean oil rallies that the spread between palm oil and soybean oil also can't start to widen again and we can't go back up. I don't know that we'll go back up to 30 cents a pound, but it could rally from where it's at. That's not what I expect. I expect it to kind of continue to narrow a little bit. It's the level that it's been at is pretty close to where I had expected it to get to by the end of the marketing year. So it's gotten there a little bit more quickly than I expected. And it may continue to move lower. It just will depend on whether Malaysian production actually slows or it doesn't slow. Now, one of the things that was a little unusual in the February data was the oil extraction rate. So the oil extraction rate had been running about 19.75%, and February's rate was a big drop from where it had been. February is usually the lowest extraction rate of the year, so it's not surprising that it went down from where it had been, but it still was a little bit lower than sort of the level that would have been implied by the historical data. I think the other thing that is important from the Malaysian palm oil board data is the fact that exports didn't really slow that much. Now, it's not that exports are really setting the world on fire, or that they were way above market expectations, but given what has been going on recently in terms of demand out of India, I think in particular, and the fact that that there still is sort of this preferential treatment for sunflower oil and soybean oil. It's not that their import tax rates are that different. It's just that they are generally higher, and now that they're even, it makes them more attractive than palm oil. So we've seen a slowdown in shipments to India, given that the export performance has been it has held up a little bit better than I expected. We'll see if that continues, and we'll see what happens after India ends the special treatment for veg oil imports a little bit later in this year. I think it's actually at the end of this month that ends. Outside of that, the only other thing that I would say about the MPOB data is that you did have strong domestic use, and so while I'm not loving the number that I have for non-biofuel use, if domestic use remains strong, then it could be that that number ultimately is where we end up. All right, now on to our expectations for the EMTS data that is going to come out on Thursday. And this just shows the sort of regional profitability of biodiesel production, assuming that you use soybean oil as your feedstock. And the interesting part about this chart is the narrowing of the spread between the California market, which is the blue line that's always on top, and all of the other markets, particularly the Southeast. So that spread has dropped to 8.6 cents, and that is lower than the average over the last couple of years by about 7 to 10 cents, I think, if I'm remembering correctly. The decline in biodiesel prices relative to renewable diesel prices is one of the reasons that that the biodiesel profitability in the California market has moved so much lower relative to the profitability in the rest of the country. The other thing that I would say about this is that while that has come down, and this kind of goes back to last week's conversation about the margins and the sharp decrease that we were seeing and projecting in biofuel margins in the California market, it doesn't look like that is necessarily translating into similar declines in other markets. And while that move in California still worries me from the perspective of my whole theory my whole theory about renewable diesel producers needing to overproduce relative to the mandates, or I guess the biomass-based diesel industry needing to overproduce relative to the volume suggested by the mandates. It all rests on the idea that biodiesel capacity doesn't shrink in a substantial way in 2023. And the California market scared me because if that was what was happening in biodiesel margins sort of across the country, then you could have a situation where at the very least you take out the integrated biodiesel producers, which have about 650 million gallons a year of production capacity. Since that's not happening, I still feel a little bit better about that whole theory, but we're going to have to continue to obviously monitor what's going on with margins. The other thing that I would say is that given the sharp declines that we've seen, not only in soybean oil prices, but also in fat and grease prices, those things are used in almost everything. There are very few products that don't have some soybean oil or some fats and grease or some vegetable oil in them. That stuff is in just about everything. And in the past, it has been a relatively good indicator, relatively good early indicator of economic activity. And so I think this time it's probably not as straightforward as it has been in the past. There are other reasons why right now prices are so weak. People have been out of position. They have more feedstock than they need, and that has contributed greatly to the pressure on prices. But since the Federal Reserve has been really aggressive in trying to tame inflation, what generally happens at the end of those cycles is you get a slowdown in economic activity because money becomes more expensive, and so of course there's an economic slowdown, and the decline in prices in the veg oil and fat and grease markets may be an indication that that is actually happening. And if that is true, then the demand for diesel and biomass-based diesel could be lower than we are expecting. You have to remember that while the EPA releases volumetric mandates, so the EPA says we're going to use 15 billion gallons of ethanol, and we're going to use 2.6 billion gallons of biomass-based diesel. The actual mandates are percentage. So when you break the sort of headline mandates down to a obligated party level, the obligated party doesn't get you have to blend 250 million gallons of biodiesel this year. They say you have to blend a percent of your total usage. And so as usage comes down, the mandates also come down. And that may be a way that you get lower production as well. It still doesn't solve that still doesn't solve the renewable diesel capacity utilization problem, but it does say that, okay, well, I guess it increases the chances that at the very least you get the integrated biodiesel producers to operate at capacity utilization that is below the historical their historical average. And you have to remember, for the integrated producers, they essentially have an option on soybean oil. They can, if it's more profitable for them to turn it into biodiesel, they can turn it into biodiesel. If it's more profitable for them to sell it to somebody else, then they can sell it to somebody else. It's not that they don't need to cover sort of, fixed plant and equipment and all of those costs, but given that it's one plant in ADMs, and it's not just one for them, but it's a relatively small portion of their overall business, operating at below capacity utilization rates that are lower is easier for them than it is for a renewable diesel producer that only has one new plant that they need to pay the debt off on, or for even renewable diesel producers that have several plants that they have had for a couple of years at this point, but they still need to pay the debt down. They still need to operate at capacity utilization rates that will cover their fixed costs and their financing costs and make a profit for their investors. Okay, so this is the biodiesel profitability in the California market for all feedstocks. So this is just, if I only use yellow grease as a feedstock in the California market, this is what I can expect roughly profits to be based on our model, which is a rough model, rough estimation, but again, should be directionally correct. And while the soybean oil profitability and veg oil profitability has come down really, really sharply and is now, you know, at the lower end, which is kind of where it usually is anyway. You haven't seen the same kind of decreases that you've in the other feedstocks. And if you just look at sort of where everything was back in 2019 and where everything is today, in general, most of these are still higher. And this is rearward looking for sure, but again, it makes me a little less worried about my theory than I was last week. Last week, I was pretty panicked about it, honestly, when I saw the forecast for biodiesel margins in the California market. I started to think that I might have to change my whole approach to this year and kind of go back and revisit everything and redo everything. At least at this point, there's nothing in the margin data that makes me feel like I really need to do that, or that I'm going to need to do that in the short term. Now, this could all change, and again, this is rearward looking data. So we'll see what happens over the coming weeks and whether this trend in soybean oil profitability translates into broader trend in other feedstock profitability. But right now, it doesn't look that bad. And the only other thing I would say about this is just that typically there's a lag between what happens in the soybean oil market and what happens in the fat and grease market. The one time we didn't really see that was after the release of the mandates, kind of everything all fell at once. But just in your average, soybean oil moves higher, soybean oil moves lower. There's typically a lag between that move and then the move in the other feedstock markets. And it's not that it's a one-for-one relationship where soybean goes down a penny and all of the other feedstocks come down a penny. They all have their fundamentals as well. So they can move down less or they can move down more, and they can move down when soybean oil goes up. But in general, what you see is what happens with the direction of soybean oil tends to lead the direction in the other fats and greases. And if truly there is something that's going on in the economy and that's slowing down, and so feedstock prices are coming down, then I would expect that that probably the fats and greases that delay will be a little bit shorter than it typically is. All right, last really busy chart, I promise. This is just the same theory, except this is for renewable diesel. You can see basically there are kind of three groups. It's not the way that it typically is. So I think if you look back in sort of the April timeframe, the three groups are sort of yellow grease and used cooking oil, and then the other low CI feedstocks, and then vegetable oils. And what you've seen is that vegetable oils have kind of moved up into the middle group. Of course, yellow grease and UCO remain the most profitable because they have the lowest CI scores. So in the California market, they get the highest credit values. But what has been surprising is the poultry fat and distillers corn oil. Now, poultry fat isn't used that much as a feedstock, but distillers corn oil is one of the more popular feedstocks in the California market, at least based on the data that we get from the LCFS. And typically, it's sort of UCO is number one, and then tallow and DCO are kind of 2 and 3 depending on the quarter. And so the sharp decline that we've seen in DCO profitability, and the fact that while it's come back, it still remains sort of well below what we estimate the profitability of soybean oil and canola oil to be, is something that's a little bit odd, and not something that I would expect to continue. Maybe it will, we'll kind of see. But outside of that, the only other thing that I would note about this chart is, unlike biodiesel, if you look back to where we were in 2019, in general, we are at or below that level for most of these. And that starts to make sense when you think about it. Ultimately, if renewable diesel is going to force biodiesel capacity to shut down, then the difference in the spread between renewable diesel margins and biodiesel margins is going to need to narrow, and maybe even come to parity and drive biodiesel margins negative. I don't think they get to parity. I think what really happens is that you get renewable diesel margins coming down, and then that drives biodiesel margins down, and ultimately that's what drives biodiesel capacity out of business. In the California market, what we've seen is biodiesel prices have been trading at a premium to renewable diesel. That has started to reverse. That's something that just typically doesn't happen. I have in my forecast, I have that biodiesel premium kind of coming out slowly over the rest of the year. In the last couple of months, it's come down a little bit more than I had expected, and it wouldn't be surprising to me if that situation kind of resolves itself a little bit faster than I'm predicting. And so it wouldn't be surprising if renewable diesel started trading at a premium to biodiesel earlier than the end of the year, and maybe as early as the summer. When that happens, then I think that that will help the premium for renewable diesel margins over biodiesel margins. And then as renewable diesel margins come down again, it should pressure biodiesel margins. But maybe it will persist, and that contributes to biodiesel hanging out for longer than expected, and help support this idea that as an industry, they're going to need to overproduce relative to what the mandates imply. All right, last slide. So this is our forecast for domestic biodiesel and renewable diesel production in February, or what the EMTS report's really blending. You can see we're expecting both to be down a little bit from January. Typically, January and February are the two weakest months of the year. I think there's still some question how much of that pattern is ultimately going to whether renewable diesel will follow the same pattern that biodiesel has for a very long time. But we'll get that data on Thursday. Given one, where we've seen margins, two, what energy prices have kind of done, it wouldn't surprise me if we were lower in February than we were in January. The question will be what happens really, or what's happening right now in March. And typically, again, March starts to be the recovery from the lows in January and February. But while margins still remain sort of historically high, they have come down. And so that recovery might be a little bit smaller than we're expecting. All right, with that, I will take any questions that anybody has. I saw somebody raise their hand during the presentation. If you want to raise your hand, you can again, or if you want to type the question in the Q&A or in the chat, I can answer it that way, or we can be done, and we'll actually be done. That's almost early this week. All right. Okay, everybody, thank you so much for attending. I hope everybody has a great week, and I will see you all back here next week.